We are going to talk investments right now, and we have Anil Ghelani, who's joining us from DSP Mutual Fund. He looks after the entire passive investing framework at DSP. Anil, nice to have you on the show today. Good to see you. Let's start by
Likewise, Ajay.
understanding
Thank you
your
very much.
thoughts, because passive investors is a breed which is growing very fast in India. And you look at the overall scheme of things much more than individual stocks, because in a framework you form a policy and then you form a collection of stocks and then you bet on that for the long term. First of all, how are you looking at market structure, the macros, the quality of earnings and valuations?
Sure, Jay. I think right now, if I would say, I'm looking at the broader equity markets with three big things: CFE, corporate earnings, flows, and event risk. So, if you look at corporate earnings first, after 2021 October, when the broader equity market was at high levels, we are today in around 19th month of consolidation, where the broader markets have remained in a range-bound situation. Of course, we made a fresh lifetime high during December 2022 at about 18,700 levels. But after that, there is no directional move. And hence, now today, if we see from that peak of 2021 October, we are close to around 2-3% away, basically, in terms of the broader markets. But corporate earnings, which I said, the CFP, the first big thing which we are looking at, is rising and it's becoming healthy. So in this last about 18-19 months, if we see corporate earnings, like we typically monitor the trailing 12 months earnings per share or EPS, which has risen from around 650 levels to around 850 levels. So because of that, though market levels have remained same, the PE multiples or the earnings multiples have reduced by around 7 points from around 28 times to 21 times. So along with that, we have seen even the price to book level falling down by around 0.4. So 4.6 was the price to book, close to about 4.1, 4.2 levels now we are running currently. So with this corporate earnings climbing higher, we believe that the premiums have come down and hence equity markets appear even more better poised than before. Second point, the F part, the flows. Now, no doubt over the past couple of years, we have a steady flow from the domestic investors also, mutual fund, NPS, etc. But FII flows are also important to track and analyze. So if we see last 3 months, FIIs have bought Indian equities worth close to about $5 billion. Now, during the last quarter of 2022, when we were at lifetime highs, at that time, our Indian equity market, if we look at compared to the emerging market peers, it was almost around 90% premium. And from that level, that premium has declined almost half. And now it's at about 45 to 50% premium, which is close to a broad 10-year average that we have seen around 42%. So this, we believe, will be an important driving factor, which will lead FPIs, foreign investors broadly, to continue seeing India markets favorably. And hence last year's flows, which were typically large outflow of around $15 to $16 billion in the whole of calendar year 2022, maybe we will see a good, healthy and a stable kind of a smoother flow in the current year. The third part, the E part, the event risk that I mentioned, all of these can come to risk if there is a sudden unexpected event risk. What we are all watching closely is the US markets, the debt ceiling limit. Of course, we have got data historically that from early 1900s, when the ceiling has been set up, almost 98 times, around 100 times, this ceiling has come up and it has been increased. So definitely, large part of the market participants are expecting it will be raised again. But at least till late last night India time, it is not yet done. So some bit of uncertainty definitely remains in the markets. So these three things are broadly to watch for, basically.
And we understand that, there is a view in the market that passive funds only have to be in large cap. But very few actually realize it, that there are now a lot of passive vehicles available to participate in the broader markets as well, which is actually the true India story, the mid and small cap end of the market. What are your thoughts about the valuations and the triggers around the mid and small cap, and also how to play that market via a passive vehicle?
Super point. Historically, as well as today, larger portion of our India's passive investments portfolio does lie into the large cap space. That is like defined by the, let's say, top 100 companies by market cap. Structurally, I also am a firm believer that in large cap space, outperforming of the broader indices or broader markets has become more and more difficult. So one should consider to invest via passive funds like ETFs and index funds. But let me tell you now, gradually, even in mid cap space, it has been changing. Still, the third level, small cap space, I would still believe there is some time. In Indian market, we still do have an opportunity to create alpha and outperform the broader index. So let's say large and mid instead of small, basically, can be something which passive investors can look at. So if we see the mid cap space, let's say certain segments of the mid cap ranking stocks from 101 by market cap to 251. So this pool of 150 stocks is where there is a good sweet spot, as you very rightly said, Ajay. The somewhat, in some sense, like the India story can be played out through this part of the market as well. In that, I believe very important to keep in mind that in mid caps, as we move, chances of big accidents or certain stocks not doing well is relatively much more higher. Hence, we need to try and focus on quality aspects first. So when looking at mid caps for passive, where we are mandated to follow one particular underlying benchmark index, I strongly believe that we need to create the focus around quality and then look at the other aspects. So rather than looking at full mid cap and buying that, if there is some area whereby we can filter out the entire 150 stocks of mid cap and then create a quality focused portfolio, that in my sense would be a good way for passive investors like index funds and ETFs to invest into this mid cap space. And over there, very rightly you mentioned that in this last about these 19 months where there has been a broader consolidation in the market and broader levels like Nifty 50 has remained flattish structure, or only 2 to 3% down from these last 19 months. But in mid and small cap space, we have seen quite a good level of a long period of consolidation. So it does offer attractive opportunities in certain pockets.
All right, Anil, we'll let you go on that one. Thanks so much for joining us with your thoughts on the market and also how to play the broader markets via the passive route. Time for a short break.